Well, guess what? In this video, I'm explaining 4 essential strategies that every pension holder must know so you can protect your income, avoid being taxed too much, and get the most from your benefits. You know why? Because retirement planning with a pension is different from retirement planning without one. As of 2024, only 24% of working Americans have access to a pension, and most of them work in the government. If you're one of the few who does, your personal finances are already unique. It means your retirement planning is completely different from the majority of people out there. Most people only have one source of guaranteed fixed income, and that's Social Security. You have a second source, a monthly pension income, and that changes the game for retirement planning. How does it do it? Well, let's dive in. So step 1 is understanding exactly what kind of pension you have. Is it a defined benefit plan with guaranteed monthly payments for life, or a cash balance lump sum option where you get a one-time payout that you can invest yourself? This single detail changes how predictable your income is and how much risk that you'll carry. In this video, we're talking about a defined benefit plan where you do not have the choice of a lump sum payout that you could roll over. It's going to be a monthly income. So you need to know your formula. Start by asking your HR department what formula they use. Most use a variation of years of service times some multiplier times your final average salary. For example, 30 years of service times 2% times $80,000 equals $48,000 a year for life. But the formula doesn't stop there. Is there an inflation enhancer or not? Well, many pensions don't have any inflation enhancer. That means, in that example, that $48,000 is the same every year of your life. Some pensions do have an inflation enhancer. It might be 1 or 2% per year, but rarely, and I mean rarely, does it increase at the same rate as inflation over retirement. So what does that mean? Well, it means that although you have an extremely valuable fixed income source in retirement, it is likely that it's fixed. What if future inflation is 3%, 4%, 5%, or even more? It means that that income will become less and less valuable over time because it will purchase fewer goods and services to live on in retirement. So get clear on what your pension is worth today and what it'll be at your target retirement age. That's the foundation for deciding when to take it, how to protect it, and how it fits into your bigger retirement plan. All right, fun stuff. Taxes. Pensions are taxed as ordinary income, which can push you into higher brackets, making more of your Social Security taxable and even raise your Medicare premiums. You know how most people in the financial media will say that you'll be in a lower tax bracket in retirement than you are while you're working? Well, on the surface, that makes sense. You aren't working anymore. But you know what? Often that isn't the case. In fact, in my 25 years of working with retirees, I've noticed that the vast majority of people I work with retire, and other than a few years early in retirement, are often in the same or higher tax bracket than when they were working. And guess what? If you have a pension, that's even more likely. You need to coordinate your pension with your Social Security strategy, withdrawals from retirement accounts, any annuity or rental property income that you have, and your required minimum distributions. Even know that we now have a $6,000 per person, if you're 65 or over, temporary tax deduction called the senior bonus. Social Security is still taxable. For single filers with provisional income above $34,000 and $44,000 for joint filers, up to 85% of your Social Security benefits could be taxed. And it's very likely that someone with a pension, Social Security, and modest retirement account withdrawals will be in the same tax bracket as before retirement. And depending on what happens to the tax code, it's possible that you're in a higher one in the future. The Big Beautiful Bill, while highly controversial, did one thing for retirement planning that we can agree on. Whether you like the tax rates or not, they are now permanent. So we can have clarity on them. There's no expiration date, although a future Congress could certainly raise them. And by the way, if you want a summary of what I think are the critical tax planning parts of the Big Beautiful Bill, we created an ebook that you can download for free on my website, celestialwm.com/BBB ebook. And I'll provide a link to it down in the description. All right, if you're going to retire with a pension, you want to start modeling now what your Social Security will look like at full retirement age and what your pension benefit would be. That would be your baseline of income. No matter what, you'll have taxable income of that level. You can project what your future tax rate would be and whether or not you will get hit with Medicare surcharges called IRMA. But remember, this is before retirement account withdrawals and annuity or rental property income. Once you reach a certain age, currently 73, but moving to 75 in the next decade, you are required to start taking money out of your pre-tax retirement accounts, whether you need the funds or not. And this catches a lot of people off guard who can live on a pension and Social Security alone. It creates another taxable income that they don't need, pushing them into ever higher tax brackets. For instance, let's assume you have a $500,000 pre-tax retirement account that you accumulated while working in addition to the pension and Social Security. This is the table for calculating how much you must take from your retirement account at age 73. $500,000 divided by 26.5 equals $18,868. That's additional income to you that is required and is 100% taxable. So what can you do? Well, first, like I said, you need to get clear on what your future income might look like. Most financial planning software can model that. And second, you want to understand what a Roth conversion is. A Roth conversion is a strategy where you move money from pre-tax retirement accounts like 401ks, 403bs, and IRAs into a tax-free Roth IRA. When you move the money, it becomes 100% taxable to you in the year that you move it. But here's the key. It is never taxed again. Not on the growth, not on the distributions. This is an important strategy for almost everyone to consider, but even more important if you're retiring with a pension. Why? Because if you're retiring with a pension, your income in retirement will likely be similar to while you were working, meaning there's a pretty good chance you'll be in the same or higher tax bracket. In either case, you most likely want to do a conversion. The only time you wouldn't want to convert is if you believe you will be in a lower tax bracket in retirement. That's highly unlikely for the 24% of working Americans with a pension. Does the Roth conversion analysis stop there? Nope. It's a lot more complicated. When you do a conversion, you want to know not only how it impacts your current and future tax brackets, but the conversion income could push you into current IRMA Medicare surcharges or the 3.8% net investment income tax that applies to singles making over $200K and married couples making over $250K. You may not make anywhere near that, but if you make a large conversion in 1 year, you could be hit with a number of these surcharges. In addition, that income could phase you out of certain tax deductions like the senior bonus. In that case, maybe it's better to spread out conversions over a period of years and even decades. I say all this because it's a complex decision, and you want to weigh the pros and cons with your tax and financial advisors before implementing any strategy. Just because you heard about it on YouTube isn't enough. Run your own numbers to find out what's best for you. See the Forest Through the Trees is more than a channel. It's a community. Get a private membership for just $2.99 a month and get perks like early video access. Click that join button to learn more. Okay, so when you start your pension, you'll have to choose a payout option, and you should take some time to consider your personal situation. Single life gives you the highest monthly check, but stops when you die. Joint and survivor continues payments to your spouse, but comes with a lower monthly amount. Period certain is an option sometimes available, which will pay you an amount in between these two for a certain period of time, say 10 years. If you retire and pass away in the first year or two of retirement, the pension would continue paying for those 10 years, giving you a minimum amount. Pick wrong, and you could either leave your spouse without enough income or take a reduced payment for decades when it wasn't needed. If you're single, the option's straightforward. You'd opt for the highest monthly amount. But for a couple, it becomes a lot more complex. If the spouse with the pension passed away, would the widowed spouse have enough income and assets? What is the age difference between the spouses? What does family health history look like? If there's a large age difference between spouses, or if you have health issues, it may make more sense for the joint and survivor benefit. For some couples that are in good health, buying term life insurance and electing the higher single life benefit is a better alternative to taking the reduced survivor option. It all depends. But what happens when one spouse passes in retirement? With a pension, this is critical to understand and to think about. When you're married, you get benefits like a higher tax bracket threshold, meaning you could have a lot more income than a single individual and not be in a higher tax bracket. Same goes for Medicare IRMAA surcharges. Same for the NIIT tax. And same for the tax deduction phase-outs. You also lose one of the Social Security benefits. It's the lower one, but you still lose it. Many times I see what I call the widow's penalty, where the surviving spouse loses Social Security benefits, but still ends up in higher tax brackets with reduced tax deductions. It's unfortunate, but proper planning can help fix that. Take advantage of being married to optimize your income and your taxes. All right, number 4, when you have a pension, you have one of the most powerful fixed income streams that you can have. You must integrate that into your investment strategy. Why? Because often, as I explained earlier, that fixed income stream is just that. It's fixed. Or maybe it increases only slightly. Your investment strategy might be different than everyone else. Your investments don't generally need to generate as much income, and you don't have to worry as much about a large decline in your portfolio in the early years of retirement because you may not be withdrawing much from it at all. You can ride out volatility a lot better than the majority of retirees, and this gives you a lot more flexibility than a lot of other people. Let's go back to that example early in the video and say you have a $48,000 pension. Well, currently the 10-year Treasury bond yield is 4.29%. You would need $1,118,881 to generate that same amount of income today. When looking at your overall investment allocation, it'd be silly, stupid, or even irresponsible not to include that as part of your investment allocation. Having a fixed income asset like that can allow you to invest more assets in growth-oriented investments. Contrary to someone with a pension who needs to have more stability in their portfolio to provide the distributions, your stability comes in the form of a pension. As you probably know, pensions are a powerful asset, but the decisions that you make about them can impact your income, your taxes, and your security for decades. Understand your plan, claim it strategically, choose the right payout option, and coordinate it with your other income streams. Done right, your pension can be the backbone of a secure and comfortable retirement. Now, if you're getting lots of value from these videos, make sure to become a community member and check out this video next for even more ways to supercharge your net worth.